Hello cosmonauts, hope you're all doing well. I'm going to sideswipe all this beef and banter on the cosmos and do a bit of analysis on a project I've been looking at for a while. This project was originally on Terra and is called Mars Protocol. They shifted over to the cosmos to make their own bloody layer 1, didn't they? So what we're going to look at today then. Firstly, social media following. Next, tokenomics. Thirdly, what do they actually do and how does it work? And finally, my final thoughts. So let's get bloody into it. Firstly then, social media following. We can see they've designed a beautiful little website, but we're smarter than being fooled by that, aren't we, cosmonauts? They've been on Twitter for just over a year and a half and amassed 69.6 thousand followers, not bad. They do not seem to have a Telegram, however their Discord has less than a tenth of the members with 6,343. With this requiring a few more clicks than just adding an entity on Twitter, I would argue that these figures represent a more realistic depiction of interest. Moving forward then, let's have a look at their tokenomics on the Cosmos. What we can see here, this is the initial tokenomics when it first came out on the Terra network. Now the airdrop was 7%, which included a lock drop. That means after the airdrop, there may be more tasks you need to do in order to release extra tokens. Now they do intend to be a bank, so they're only giving away 7% of their assets, I guess to simply engage the community, which I see as quite viable. Next we have the community at 53%. On their banking protocol, which I'll show you later, you're going to be able to stake, borrow, and lend. And through these activities, you'll be able to earn rewards. Next, 30% joint venture. Now, this one's a bit difficult, right? Because with a joint venture, this implies around 30% ownership. And my research indicates that the people that are part of this joint venture are Delphi Labs, IDEO Collab Ventures, and Terraform Labs. The team wish to be referred to as a decentralized band of contributors rather than putting faces and names to the protocol. I guess that's because they want everything to rely heavily on smart contracts. Now, the other interesting thing about these investors is the vesting period. It's only a 3-year vesting period, so over that time, these assets are going to be distributed to these joint venture participants. Now, when any investor invests in any startup, what are they looking for? They're looking for a return on their investment. They can help with their expertise, help it grow, help it develop, but they're looking for a return on their investment. So what generally happens in these cases is as soon as they get their tokens, they cash out. Now, if they cash out to get a return on their investments, what happens to the asset value? That's right, it decreases massively. Now, this also causes another sense of loss because if they sell, they lower their stake in the organization, which A may mean interest, and B is certainly their expertise. Now, when new platforms and whatnot want to come on the protocol or new lending ideas, if there is a lack of expertise in decision making about what protocols to use and what not to use, and there's a heavy reliance on a DAO, it could lead to poor investments down the line. Regardless, let's watch this space. Finally, they have 10% reserves. Now, banks have reserves, and generally these reserves are around 10%. So if I went to the bank and put in $100, that bank is then allowed to take 90 of those dollars and lend it to another person. Now, can you imagine if person 2 goes back to that bank and puts in that $90? The bank is now allowed to lend $81 to the next person. It's part of the multiplier effect in economics, and it's how banks generally create money in the economy. They can't just push a button, boop, and create money. But following that methodology, which the government can control, will determine how much lending they can actually do. So essentially in this way, they're copying banks. However, this is their old tokenomics, and now it gets a bit more complicated because they're moving over to the Cosmos permanently as their own layer 1. So what we're seeing now is something a little bit different. They had already distributed the tokens on the Terra blockchain, and new Mars tokens will be airdropped to these holders on the Cosmos. They still only have 1 billion tokens, so 6% of these are going to be able to be claimed. And then the other distribution is for Mars contributors, which I assume is these little badges here, these joint venture participants. And the rest goes to the community pool. In fact, so it looks like the 10% reserves are completely gone, implying there's more community pool control, which is quite concerning if it was to operate as a bank. Alright then, moving forward, what do they actually bloody do? Well, they boldly state this is the red bank. So with the red bank, you're going to be able to borrow, lend, stake, deposit, and hopefully do everything you could do in a real bank. Now this is the breakdown of it. It looks a bit more complicated than it is, so let me go through it slowly. So in the red bank here, we can see 4 types of consumers. The first one is simply a lender. You deposit your money in the bank and you get fees for your deposit. Simple. So you deposit the Mars token, you get returns in Mars token back, or whatever asset you decide to deposit. And I'm sure they're going to grow over time based on what the Martian Council decide. Now, next person is a borrower that borrows collateralized goods and services. So this just means DeFi is basically in infancy still. So for example, if I wanted to borrow $100 in a stable coin, I might have to put up $120 worth of Atom. And you might say to yourself, well, I can just go get stable coin of $100 anyway. So why on earth would I need this process in the middle? Well, it's basically because you're betting against whatever your collateral is. If the value of your initial collateral goes down and those ratios change 120 to 1, they may have to liquidate some of your loan to get their money back for safety purposes. However, if the value of your Atom tokens goes up, you can profit from these differences. The next is a borrower that's contract based, and this is the defining difference between this protocol and any other protocol that I've seen out there so far. With smart contracts, they're going to allow people to borrow without collateral. In the past, on these applications, you have to put collateral down that gets liquidated if the value of your collateral goes below the ratio that they expect. But in this case, through governance on the Martian Council, which is by people staking the Mars tokens and validators and stakers, they're going to make decisions about who can borrow what without collateral. Now, this is where the risk comes in. It's much riskier for the platform, which is why I'm confused about why those reserves have gone, because reserves are necessary just in case. Now, there's a reason why banks and investors give out loans without collateral. It's because they want to make money, and there is a lot of money in the loan market. And if you find great projects and you can give a more competitive rate than a bank in terms of payback, and they do well, your lending platform could be brilliant, absolutely brilliant. But there's an enormous amount of legislation and rules that you have to follow in order to be able to do this. This is why this fascinates me, because it's the next step in DeFi. These are really untested waters. And of course, to be very clear about this, they've created a massive subset of rules for the Martian Council to follow. They call it the Risk Framework 2.0. So basically, they're in the middle of creating frameworks for both adding assets and determining who they can lend to and why. And these decisions are going to be made by the Martian Council, who are owners of the tokens. When they add an asset to this bank, the first thing they're going to look at is the historical price data to try and get a value of it. They're also going to look at the historical liquidity of the asset. So they're actually trying to put some traditional finance methodologies into crypto and then into smart contracts. Very, very new, exciting stuff. It claims it eliminates politics and ensures objectivity, but the past does not directly show what's going to happen in the future. But some argue it does rhyme. And finally, the fourth party are liquidators. Now, I've talked about liquidations before and a few other rivals on the Cosmos. Both Comdex and Kujira have a very similar methodology. So basically, if I am a collateralized borrower, I put down $120 of Atom and I get 100 UST, or what used to be UST. Now, if the value of my Atom drops, I no longer have that 120 to 100 ratio. So this might lead to some liquidations. Now, with liquidations, it's an automatic sales process, but this allows people to come in and buy these assets essentially at a discount. In this case, they say they earn fees, but as soon as the value of your initial collateral goes down, they need to maintain that ratio. So liquidators come in and buy that difference. A lot of the time it's bots doing it because they know how to make a cheeky profit. If you can get $1 million of Atom at a 1% discount, you've made 10 grand. So these are the four initial expected customers. Now, as we know, validators are essentially organizations that process transactions. And with your Mars token, you are able to choose whichever validator you want. We at Tech Crypto are considering getting on there. And yeah, so the Martian Council are basically the decision makers for pretty much everything. All the new rules, all the protocols, it all seems to be a voting-based process based on smart contracts and decentralization. As you can see, it says stake the Mars tokens and get into the Citadel. Very Star Wars-esque. The user interface in general looks pretty good. So there's your deposit balance when you've put money on there. It tells you how much you're allowed to borrow and how much you have borrowed. There are tokens that you're able to borrow if you want to, and whether they come on the platform or not is decided by the council. So yeah, the user interface looks pretty good, and they've been doing a lot of testing on it recently, according to their Twitter. They call it the Rug Defense Force. So basically then, you're going to be able to stake your Mars token, which allows you to enter the Citadel and vote on new policy and lending protocols. You're going to be able to do spot and leverage trading. There's going to be yield-based vaults and using leverage to borrow assets. So there's a lot going on with this wannabe bank then. So my final thoughts on the protocol. So firstly then, before they said they wanted to add an asset to the red bank, they want to check how centralized that asset is as well as the other price fluctuations. But is that really important? In my opinion, many good organizations need to maintain some forms of leadership in order to steer the ship on the right course. If you leave everything open to the DAO, in many cases it just collapses and falls. Because people inside the DAO often don't have expertise in this field, and they've got a full-time job. They've got things to do. They've got 100 million other DAOs to deal with. Imagine osmosis without Sunny at the helm. Governance and leadership is important, in my opinion, and you're welcome to disagree with that. Also, with the team not willing to dox themselves, it is a bit concerning, but also I understand why. So basically, the first point of law is a person that doxes themselves that works for this organization, right? And that's where the law will go to. Look at the people that made Tokenomics as a smart contract platform. So unfortunately, you cannot create a smart contract platform and step away from it. So I understand why people want to create something new, create a competitor to the banks, using the latest technology in smart contracts, but not be held liable if something goes wrong, which ultimately implies greater risk. But also with greater risk is greater reward. It's a tough one because it's good technology, but if the code is solid, is accountability important? Yeah, in my eyes. In conclusion then, here's their current roadmap. They're looking to get the red bank on Osmosis and eventually expand to the multi-chain. These are big ideas, and ultimately, I think this is incredibly new technology. A smart contract-oriented bank that offers the same features as a bank, that allows owners of the Mars token to take responsibility for the direction of the bank and what it produces. DeFi is still in its infancy, and taking the step towards giving out loans based on governance that are uncollateralized is one of the first steps to actually competing with real banks, because that's what real banks do. They give out uncollateralized loans and they make a hefty profit from it. Think about having a mortgage. My mortgage cost me £2,000 just to set up. This platform will be able to give out cheaper loans and also be able to utilize some of the methodologies that are used in traditional finance. But without strong figureheads, there is of course some concern. I can imagine this kind of protocol is going to be a litmus test for any other lending protocol that wants to try DeFi banking. We're in the stage right now of trial and improvement rather than trial and error. I see DeFi as currently quite a blunt knife that is slowly being sharpened. It is not yet a threat to central banking. One day it will be, but this road is going to be incredibly bumpy. We are stepping our toes into unmarked, deep, smart contract crypto water territory here, ladies and gentlemen. Alright, interesting one for me today. I'm really curious to hear what you think about it down below and how you think it stacks up against Comdex and Kuji. Let me know. I always love seeing your comments. Hope you all have a good day, and I'll see you again.